Everybody, this is lecture for week 5 and this lecture is lecture 2. So in this topic 5, you have learned how to do accounting record. You have to do the title of this topic is accounting cycle. So in the previous lecture, I have explained that if you have to make accounting record for a business, then you have to follow accounting cycle. Accounting cycle explains about the steps that you have to do when you want to make accounting record for a business. There are 8 steps in the accounting cycle. The first step is doing analysis. I have explained that in the previous lecture. And then I have explained that during the analysis step, the thing that you have to do is you have to identify the type of a business transaction that happened, and after that you have to know the effect of that transaction on the accounting equation. For example, one of the example that you have seen in the previous lecture is let's say a business borrow cash from bank. Let's say $5,000. So when that transaction happen, the way to do the analysis is like this. First, you have to know what kind of transaction is that. The kind of transaction is the business borrow cash. And then what is the effect of that transaction on the accounting equation? The accounting equation is asset equal to liability plus equity. So when a business borrow cash from bank, the first effect is asset will increase. The name of the asset is cash. And there is a second effect. The second effect is on the liability. At the same time, the liability of the business also increase. The name of the liability is bank loan. And there is no effect on the equity of the business. Okay, that is an example of the way to do the analysis. The analysis happen in your mind only. If you are the person who has to make the accounting record, when the transaction happen, you analyze. It means that you think about it. The process of analysis happen in your mind. After the analysis, you do the second step, which is this one. You record the transaction in the journal. Journal, like I said in the previous lecture, journal is the first book that we use in accounting. Okay. So and after that, I have told you before you can do or you can record the transaction in the journal, you have to know about the rule of debit and credit. I have explained this in the previous lecture. Okay, and then I have explained about this. These are common account names that we use in accounting. In accounting, when we record business transactions, we record in accounts. So these are the common account names. Okay, this is the last thing that I have told you or I explained in the previous lecture. I have explained that there are many types of journals. At least there are 7 types of journals. But for this course, we focus on general journal. We will use a general journal to record all business transactions. The format of the general journal is like the one that you can see in the yellow box here. Okay, now this is the next thing. How to do this general journal entry. Okay, so let's see. This is a first example how to do general journal entry, or how to record a business transaction in the general journal. Okay, let's see. Supplies purchased for $250 are purchased on account. The situation is like this. There is a business. The business purchased supplies. Supplies is something like this. Supplies are things that the business use when the business provides services. For example, there is a laundry shop. The laundry shop, when the laundry shop provide laundry services, the laundry shop will use detergents and softeners. The detergents and softeners are called supplies in accounting. The laundry shop does not sell the detergent and softeners, but the laundry shop uses the detergents and softeners when they provide the laundry service. Okay, so now I hope you can understand the scenario here. There is a business. The business purchase supplies from supplier. $200, $250, but purchase on account. On account means the business purchase the supplies today, but will pay later in the future. So now, how to prepare the correct journal entry for that? Okay, remember this. The way to do the journal entry is like this. When you see this transaction happen, the first thing to do is you do the step 1 in the accounting cycle, which is to analyze the transaction. So first, you identify the type of the transaction. The type of the transaction is a business purchase supplies. And then what is the second thing to do when you analyze this transaction? You have to know the effect of the transaction on the accounting equation. Okay, what is the effect of this transaction on asset, liability, and equity? So see here, when the business purchased the supplies, $250, the effect on asset is like this. Imagine there is the business, and then when the business purchases the supplies, the supplier will send the supplies into the business. So that supplies goes into the business. So when supplies goes into the business, the effect is asset will increase. The name of the asset is supplies, and the amount is $250. That is the first effect. The second effect is the business. The second effect is on the liability. This is because the business owe money to the supplier. The business will pay the supplier later. So the effect on the liability is liability increase. The name of the account is called account payable. In accounting, if a business owe money to the supplier, or a business has to pay something to the supplier in the future, we record it in an account called account payable. The amount is $250. There is no effect on equity. So the effect of this transaction on the accounting equation is asset increase $250. The name of the asset is supplies. And then liability increase $250. The account is account payable. So then this is the way to do the journal entry, general journal entry. Remember, I have told you the first effect, the effect of this transaction on asset is asset increase. Asset supplies increase. So refer to the rule of debit and credit. When asset increase, you have to debit the account. So see here, January 1st, the general journal entry is debit account supplies. The amount is $250. And then the second effect of that transaction is on the liability. Liability increase. The name of the account is account payable. The amount is $250. So you refer to the rule of debit and credit. When liability increase, you have to credit. That's why here, in the general journal entry, you credit account payable because it shows liability has increased. So debit account payable, the amount is $250. Okay, this is the way to do the general journal entry. You do the step 1 first, and then you can do the step 2, which is recording the transaction in the general journal. Okay. Okay, see here. There is another example here. A check for 1,000 is received in payment for service rendered. So there is a business. So to make it simple, we use a laundry shop business, and then the business received a check, $1,000 check, from customer after the business do a service, provide service. So how to record that? Like I said earlier, when you want to record this in the general journal, first you have to do the first step in the accounting cycle. You analyze the transaction first. Okay, what type of transaction is this? The transaction is the business receive cash after providing services to a customer. And then, okay, what is the effect of this transaction on the accounting equation? Imagine there is a laundry business, and then one day the laundry business provides services to one customer, and then the customer pay $1,000 using a check. Okay, so when the customer pay the $1,000 after receiving service, so the effect on asset is like this. When the customer pay $1,000, asset cash increase. It is like cash $1,000 goes into the business. So for the business, the asset of the business increases. And the name of the asset is cash. The amount is $1,000. Is there any effect on liability? There is no effect on liability because the business does not owe anything to anybody. Okay, but is there any effect on the equity? Okay, now you have to remember the thing that I have explained in the previous lecture. Equity is related to 4 accounts: capital, withdrawal, revenue, and expenses. This 1,000 is a revenue because the business received that after providing services to a customer. So the effect on the equity is like this. Equity increases. The account is revenue account. The amount is $1,000. So the effect of this transaction on the accounting equation is asset cash increase $1,000. No effect on liability. And equity increases $1,000. The account is account revenue. So asset increase. Remember, according to the rule of debit and credit, asset increase, you debit. So that's why, see here in the general journal entry in the yellow box, you debit account cash 1,000. And then the second effect on the accounting equation is equity increase. Okay, can you remember what is how to record an increase in equity? Okay, you have, according to rule of debit and credit, when equity increase, you debit. When equity increase, you credit. So that's why you credit equity, the name of the account, service revenue, $1,000. So the type of the transaction is receive cash for services. Okay, this is another example how to do general journal entry. Okay, now the situation is like this. The business provide services to a customer on account for $750. So imagine there is a laundry shop, and one day the laundry shop provides services to a customer. The business charge $750, but the customer will pay later. So what is the effect of this on accounting equation? You have to analyze this. So you have to, when you want to record this transaction, you have to follow the accounting cycle. do the first step first. So you have to analyze the transaction. The type of the transaction is a business provides services to a customer in credit. The transaction is in credit because the customer received the service today but pay later. Okay, what is the effect of this transaction on the accounting equation? The accounting equation is asset equal to liability plus equity. So see, what is the effect of this on asset first? When a business provide services to a customer, but the customer will pay later, in accounting we have to record this in an asset account called account receivable. In the previous lecture, I have explained about account receivable. Account receivable is used for the situation like this. You have a business. A customer will pay you later, or a customer will pay an amount to your business in the future. So in accounting, for that situation, you record the amount in account in an asset account called account receivable. It is an asset because your business will receive something in the future. So that is an asset. Your business will receive something in the future. So the effect of this transaction on accounting equation is asset increases. The amount is $750. The account name is account receivable. Okay, that is the first effect. Is there any effect on liability? There is no effect on liability. Liability is can be understood as debts. The business does not borrow anything from anybody, so there is no effect on liability. How about equity? Is there any effect of this transaction on the equity? Yes, there is an effect on the equity. Because the business has provided services to a customer. So in accounting, when a business provided services to a customer, the transaction had happened, you have to record that as revenue. Okay, that is the business provide the services, $750 services. So the effect on equity is the equity increase. The name of the account is revenue. The amount is 750. So there are two effects. Asset, account receivable increase 750. How to record that? Asset increase, you debit. So that's why in the journal entry, you write the date and then you show account receivable debit 750. When you see that, you know, oh, account receivable has increased 750. And then the second thing is the effect of the transaction on the accounting equation is equity increase. Equity increase, you check the rule of debit and credit. Equity increase, you have to credit. The name of the account is account revenue or service revenue. The amount is 750. So the type of the transaction or the explanation for the transaction is the provide services on account. So when you during the examination, most of the time you will be asked to do general journal entries. So when you have to do that, you have to show the date, the debit account, the credit account, and the amounts. But the explanation can be so I think it is not during the exam. It is not compulsory to write the explanation because for me, if I see you if I see the debit account and the debit account, then I know what is the transaction. Okay, so the explanation is not compulsory for me during the examination. So remember that. Okay, so you have seen 3 sample journal entries or example of journal entries. So in the journal, like I said earlier, journal is like a big, it's like a big book. So in the journal, the record will look like this. You can see that in the general journal book, there are columns for dates, transaction, debit and credit columns, and then you can see the record is in the chronological order. The first transaction will appear first, later transaction will appear later. The record is according to the time when the transaction happened. Okay, so in the real situation, most of the time every account has a reference number. For example, here cash has the reference number for cash is 101. So this reference number is used by businesses when they want to transfer the journal entry into the ledger, which is the third step in the accounting cycle. Okay, that is the. Okay, now we see here there are several more transactions, and I hope you can think how to record this sample transactions in the general journal. Okay, let's see here. 1st of November, business ABX pays water and electricity bill $410. Okay, how to record this in the general journal? Okay, first, remember, what is the first thing to do when you have to do the general journal record or entry? First, you have to do the first step in the accounting cycle. You have to analyze the transaction. So the type of this transaction is a business pays utilities. In accounting, when a business pay electricity, water, telephone, internet, etc., we categorize that as paying utility expenses. Okay, we in accounting we group them together. We call them utility expenses for water, electricity, telephone, internet. So that is the name of the transaction or the type of the transaction. Now, second thing, what is the effect of this transaction on the accounting equation? Okay, what is the effect of this transaction on asset first? When the business pay $410 cash, it is a cash out. So the effect on asset is asset. The name of the asset is cash decrease $410. And then what is the effect of this transaction on the liability? There is no effect on the liability because the business does not owe anybody. And then what is the effect of this transaction on the equity? Okay, remember that equity is related to 4 accounts: capital, withdrawal, revenue, and expenses. This is an expenses. The expenses name is utility expenses. Okay, for this situation, the equity decrease because there is an expense of utilities, or there is utility expenses. The amount is 410. So there are two effects of this transaction on the accounting equation. First, asset cash decrease $410. Second effect is equity decrease. The account is utilities expense. The amount is $410. So how to record that in the general journal? First, you have to write the date, 1st of November. So the first thing is asset decrease, asset cash decrease. So you have to credit account cash 410, and then the second effect is equity decrease. The account is utilities expense. So equity decrease, according to rule of debit and credit, you have to debit the account. So debit account utilities expense $410. The type of the transaction is pay utilities $410. Okay, see the second transaction here. 3rd of November, the business borrows $10,000 from a bank. Okay, what is the effect of that on the accounting equation? When a business borrow money from bank, asset cash increase $10,000. The second effect is liability increase $10,000. The account is account bank loan. So how to record that in the general journal? Asset increase, you have to debit. So 3rd of November, debit account cash $10,000. And then liability increase. The account is bank loan. So the second entry is credit account bank loan $10,000. And then, okay, the next example. 10th of November, the business purchases an equipment $1,200. Okay, assume that this business purchase using cash. So what is the effect of this transaction on the accounting equation? When a business purchase equipment, the effect is like this. The effect on asset is like this. As when imagine there is a business and this business purchase equipment. When the business purchase equipment, the business pay first. So the first effect on asset is asset cash decrease $1,200 because the business pay somebody. So cash goes out. So asset cash decrease $1,200. The second effect is after the business pay something, the supplier will send the equipment. So asset increase, the name of the asset is the equipment $1,200. So for this transaction, there are two effects on asset only. Asset cash decrease $1,200. At the same time, asset equipment increases $1,200. So how to do the general journal entry record for this? So you write the date 10th of November, and then cash goes out, so cash decrease. Credit account cash $1,200. And then equipment increased $1,200. Debit account equipment $1,200. So that is the way to do the journal entries for this. Okay, so if you have to make accounting record for a business, it means that when you have to do the journal entry every day. So every time a transaction happen, you analyze and then record in the journal every day until the end of the year. Because according to the time period assumption in accounting, a business has to close its account at least once a year. So at the end of the year, you have to close the account. So you do the analysis and record in the journal every day. At the end of the year, when you have to close the account of the business, you stop. And then you do the step 3 in the accounting cycle, which is related to ledger. Ledger is another book that we have in accounting. Okay, in step 3, the thing that you have to do is you have to transfer all the journal entries or journal record into another book. The book is called ledger. In the ledger, there are many accounts. The format of the account that we always use is T accounts. Imagine there is a book. In that, the book is called ledger. That is the second book in accounting. Inside the book, there are many accounts. Okay, account cash, account receivable, account inventories, account supplies, account land, building, furniture. equipment. Okay, so you have to transfer all that in the accounts. These are several things. There are several terms related to journal. The first term is posting. Okay, posting. The correct or the typical word used to explain the process of the process in step 3 is posting. Posting means transferring amounts or data from journal into the ledger. Ledger, what is a ledger? Ledger is a book of accounts where journal transactions are posted and thereby summarized. In the ledger, in the book that we call ledger, there are many accounts. Posting reference, a cross-reference number between the general journal and the accounts in the general ledger. Remember, I have told you in the previous slide. There is an example that shows that cash has a reference number of 101. Okay, that is the reference number. When you transfer data from journal to the ledger, maybe this reference number is useful because you can check the code of the account. And chart of accounts. Okay, ledger is like a book, a big book. So at the yearly page of the ledger, that is like several pages that show the content of the ledger. So that content of the ledger, we call it chart of accounts. It shows the list of accounts in the ledger and also the codes for or reference number for each account. Okay, this is an example of chart of account. Like I said earlier, you can see chart of accounts in the yearly pages of the ledger book. Like you open your textbook, the yearly pages show the book contents. You can see which for this title in which page. So the same goes like this chart of account. In the ledger book, at the beginning pages, you can see the chart of account. There are in this chart of account, you can see a list of all accounts with their reference number. So this chart of account make it easy for you to check. Let's say one day you want to see the sales revenue only, so you can see the reference number is 400. So you like open page 400 in the ledger, and or you search for number 400, and you can see all the record related to sales. Okay, in the ledger is like a book. In the ledger, there are many accounts. The typical format that we use is called T accounts. Okay, T accounts. So the format is like this. You have to write the name of the account at the top of the T. The left side of the T account is called debit side. The right side of the account is called credit side. So the thing that you do when you prepare the ledger is like this. Remember, I have told you in step 2, at the end of the year, you stop recording in the general journal. You stop, and then you do step 3 in the accounting cycle, which is this step. You have the ledger book, and then you transfer all the journal entries from the journal book to the ledger, to the accounts that you have in the ledger. All transactions related to cash will go to cash account. Okay, so you will see later, I have another video explain about the process. You have to transfer all the data from the journal into these accounts, and after that you have to, after you have transferred all the data from the journal to the ledger, you have to close all the accounts. There is a way to do that, and you will see the way in another in videos I prepared to show you how to do this process. You have to close the accounts and then you have to calculate the balances for all accounts. Okay, after you have calculated balances for all accounts in the ledger, then you can do the step 4 in the accounting cycle. Step 4 in the accounting cycle is called preparing trial balance. A trial balance is a list of all accounts that you have made in the ledger with their balances. So trial balance is a list of all accounts with their balances. Okay, I will show you. This is an example of trial balance for a business. See here, the format is very easy. In the first column, you see a list of all accounts. Cash account, account receivable, inventory, land, account payable, capital stock, return earnings, sales revenue, goods, cost of goods sold, advertising expenses, miscellaneous expenses. This is the list of all accounts. And then you have to show the balances for these accounts. Some accounts, particularly asset accounts and also expenses accounts, they have debit balances. Other accounts, particularly the liabilities and capital and revenue, have credit balances. This list of all accounts and their balances are coming from the ledger. Okay, later I will show you how to prepare this trial balance. Okay, I've made several videos for that. So today it is like understand the flow first. Later I will show you how to do it. Okay, so see here, the purpose of preparing a trial balance is to check whether the recording process in step 1, 2 and 3 are correct or not. Most of the time, if the total amount in the debit equal to the total amount in the credit side of the trial balance, if the total amount in the debit equal to the total amount in the credit, then most of the time the recording process done in step 1, 2 and 3 are correct. If you prepare a trial balance, then you found that the total amount in the debit side does not equal to the total amount in the credit side, then you have to know there is something wrong in the in step 1 or step 2 or step 3. So you have to find the error or mistakes, and then you have to make corrections, and then after that you can be sure that the recording process that you have done are correct. Okay, this is a sample question. You can see there are like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I think there are 10 business transactions happen in the month of January. These transactions are related to a sample car wash business. When you read this sample transactions, it is like this business is owned by you. This business is your business. You start the business and then you pay something, you receive cash from customer, and then using this sample transaction, you are asked to make accounting record for your business. So the accounting record, when you are asked to make accounting record for a business, you have to follow the accounting cycle. So first step is to do the analysis and then record the transaction in general journal, and then post the journal entries into ledger, and prepare a trial balance. So this question asks you to do the first 4 steps in the accounting cycle. So I have prepared videos, 4 videos for this sample question. I will share that videos with you, and you can see the flow of the process, the flow in the accounting cycle. Okay, that is what I will do. Okay, this is like additional things that you have to know in this topic. Describe how technology has affected the first 3 steps of the accounting cycle. So, one thing that you have to aware now, the way that you have seen in the previous slide, the way I explained about how to do the analysis, how to do the journal entries, how to do the how to prepare the ledger and trial balance, can be done manually, and also can be done using computer software. Many years ago, before we used computer in accounting, so many years ago, all the process is done manually. So the person who will do this is an accountant. He has to record everything manually in the journal, in the ledger, and then prepare trial balance manually. But now, when we have technology, there are many softwares out there that can be used to do the same thing, and it can do the accounting record from step 1 to step 4 very quickly. You just enter the name of the account, and then enter the amount related to the account. Then the software can record in the journal, and then transfer to the ledger, and then with a click of a button, you can print the trial balance. Okay, there are several advantages of using computers or software. Okay, here are the advantages. First, you can process large amount of data and information very quickly without errors. If you do it manually, maybe you do errors. But if you use computer, most of the time, it can be done without errors. And then second advantage is more documents can be produced than humanly possible in the same amount of time. So if you use computer software, you can print the ledger, the journal at any time, very quickly. But if you record it manually, you have to open the book, you check the page number, you check the reference number, so it takes a longer time. But using software, it can be done very quickly. Common tasks can be automated for increased efficiency. So this is another thing. If you use software, you enter one number, the software will update all the journal, the ledger, and can also update the trial balance. But using computer and softwares, there are several weaknesses or disadvantages. First, computer hardware and software require human judgment and input. Okay, remember this. The technology is a machine. No matter how good the technology is, still it needs human. It needs us to enter everything, to do the judgment, to select the data. Okay, and the second disadvantage is GIGO, garbage in, garbage out. Garbage in, garbage out means if you use computer software to do accounting record, if you put wrong number, then the output will be wrong. That's the simple way to say about it. The computer cannot think. If you put something wrong, you put wrong data, the output will be wrong. Okay, and then once an error is identified, fixing the problem may require many adjustments. So there is one weakness of using software when you do accounting record. If there is an error, sometimes they're very difficult to make correction. you have entered the data, how to take it back. But if you do a country record manually, if you do errors, you just can identify the error, and maybe you just can erase the number, put a new number, so everything will be correct. But using computer, you have to identify and how to make correction. Maybe difficult to make correction because the data is stored digitally. So imagine it is a bit difficult to make correction. Okay, thank you very much. This is the end of lecture for part 1. Topic 5. Do not forget to write your name and metric number in the comment section. I have told you I will share with you videos for the sample question. I will share the videos after this. Thank you very much.